King Cash, Buffett, and gold. It's an old saying for a reason. Whether you own mining stocks, technology, or even utilities, the classic market saying, sell in May and go away, is in full force right now. According to Bank of America, cash levels among investors hit the highest level since September 2001. Record cash levels indicate that investors are piling out of stocks and into safety of cash. With inflation high, fears of economic growth slowing, stagflation, as the economic term is coined, is a real concern. We have long touted the US dollar as a currency of choice. Cash is a position. It allows you to take advantage of situations and opportunities, like fire sales that come up from time to time. And we're close. In both bull and bear markets, it's uber critical to consider it a legitimate position in your portfolio. Volatility traders are pricing in more risk. You've probably heard of the VIX. The Volatility Index, or VIX, is a measure which uses S&P 500 option activity to price how much the market is expected to fluctuate over the next 30 days. From 2012 through to the COVID pandemic, we were in ultra-complacent mode. Fueled by a highly complacent Federal Reserve, near-zero interest rates propped up equity markets and provided a tailwind to the markets. We can see the sense of complacency through the VIX. Using a 12-week moving average smooths the data and shows a very clear trend of minimal volatility over that 2012 to 2020 period. Volatility is now on the rise again. As the market has awoken from its complacent slumber, with many investors realizing that buying equities based on hopium may not be the best decision. However, we're not anywhere near peak levels seen during the 2008 Great Financial Crash or the 2020 March Panic, which means there's room for more pain if it comes. Use volatility to your advantage. In short, panic equals opportunity. Investors with cash can capitalize on weaker hands, buying up high-quality assets and cheap valuations. This is exactly what legendary investor Warren Buffett just did. Berkshire Hathaway was a net buyer of equities through the first quarter of the year, buying up $41.5 billion in stocks. Professional investors have a toolkit of indicators, both financial and technical, to help them make the best decisions possible. One of the many indicators we use is the ratio of the S&P 500 to the S&P Global Commodities Index. It truly shows the cyclicality and crushing power of bull and bear markets. We like it because it shows relative strength. When the ratio is very high, it means commodities are expensive relative to the equity market. When the ratio is low, equities are seen as expensive relative to commodities, and we are seeing a noticeable uptick. Now, you could make the case, looking at the chart, that it looks like commodities have turned the corner. The devil is truly in the details, though. If the equity market collapsed and commodities remained even, the ratio would increase. Yet commodity investors wouldn't have made any money, though they would have lost less than if they played in the equity market. The Energizer, Buffett's inflation bet. As we mentioned, the ever-conservative Buffett was a big buyer during the first quarter of the year. As the ultimate value investor, when he buys, it's a good signal, but what he buys is even more valuable. After all, not all stocks and sectors go up together. According to the most recent 13F SEC filing, Warren has indicated his positions in energy stocks, all while selling pharmaceutical businesses. Long energy, selling pharma. That's a bet on inflation. Pharma is going to see increased costs, and it may be harder to pass those costs on to the customer. This will result in lower earnings. In addition, higher interest rates mean higher costs of capital and debt for pharma, which can slow down corporate growth rates. That will in turn directly impact share prices. Oil, on the other hand, will be able to pass on some of those costs, though not all, while reaping high selling prices. This pharma oil trade is a replica of the buy relative strength, sell relative weakness displayed in the S&P 500 versus commodities ratio chart you saw before. When will gold glitter? Diving deeper, you'll see that not all commodities are receiving the same support. Given political unrest and inflationary concerns, gold should be performing well, but it is having a very tough go as the US dollar continues to rip higher. Gold is hovering near $1,800 per ounce and has broken below its 200-day moving average. If the 50-day moving average crosses below the 200-day, this will form the infamous death cross, a bearish technical pattern. Defense wins championships. At Katusa Research, Marin's style is very different than most others you'll find, regardless of whether they're professional fund managers or self-proclaimed experts on YouTube and TikTok. In fact, many don't like the style. The reason? He bets with his own money and has a long-term approach. That's what we look at Katusa Research. Some find it uncomfortable that we talk our own book, but subscribers and readers and Marin wouldn't have it any other way. This means that sometimes we can be very defensive and other times very aggressive in the markets, normally at the exact opposite times others are. In the March 2020 pandemic crash, we were buyers of electricity providers and natural resources. We crushed it. Last year, we sold large positions of our gold stocks near the peak, just as everyone was piling in. As you can see, we go against the tide a lot of the time. We've been in this business for 20 plus years with many scars to prove it. And right now, Marin is being very highly tactical. It's a spooky market, and don't think all the risk is priced in right now at this point. We're keeping a close eye on fast flash crash type opportunities in the market. If you have cash ready and want a leg up, consider becoming a member of Marin's premium research service, Katusa's Resource Opportunities. It's a personal research and opportunity journal where Marin details what he's doing with his own money. If you want to give yourself an edge, click on the link below.
Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.